Here we are. Let's do it now with Daragh Maher joining us, Head of Research Americas, Head of FX Strategy at HSBC. What are the ramifications of DXY breaking through 1 to 13? What are the ramifications of resilient and then stronger dollar as HSBC is nailed for 3, 4, 5 years?
Well, it's been going well, thank you. Can I just say, and it pains me to say this, good call John yesterday on the coverage around the Fed, because you got the statement. He said, well, hold on, we haven't had the press conference yet. And that absolutely turned things on your head, as you all said. So sorry.
John did well, but I didn't do well.
I'll take that.
Yeah, well, he shone yesterday.
Daragh just knows that it's my turn to buy the round when we go for drinks next. And
That's exactly
okay, very good.
No, but
Let's continue. Strong dollar. What's it mean, oh wise one?
I think what's curious is the way you framed that question earlier. Is like, are we talking rates or are we talking relative? Why can't we talk both? It's both about rates and global growth, not U.S. growth. And I think that's the mistake the currency consensus has made. They've looked at the U.S. economy and said, hey, our interest rate sector is slowing. That will temper the Fed. That will temper the dollar. But the reality is the dollar is trading off deceleration in global growth because everyone's having to hike rates. On the U.S. side of the equation, as it's become abundantly clear, amazing work by the Fed yesterday to be able to get us on a slower trajectory for rates without fostering a massive risk-on move, without fostering kind of, oh, this is the end of the tightening cycle. I mean, that they must have spent long and hard thinking about how they're going to do that. And so I thought cleverly done.
The hawkish step down, right? I mean, this is sort of what people were expecting and what they delivered on. So I don't understand, though, what could change the story that you just said. Because you have a Fed that's hiking rates potentially to a higher level than previously expected. And you also have a U.S. economy that's better than so many of the others and more resilient. So what's going to change the dollar story throughout next year?
Well, I think the data. I mean, honestly, that's what we'll end up coming back to. If you get 2 or 3 months of core CPI printing 0.2 or non-farms coming in 100,000 or less, then that allows the Fed to say, kind of, our work is done here. That's the key. But the market's just so impatient for that. They want to say, well, let's anticipate that and expect that to come in 2023. But the Fed's saying, we've been getting this so wrong for so long on inflation. We got to see the numbers. We can't anticipate the numbers.
So right now you're projecting a terminal rate of 4 3/4 to 5%. The market's actually ahead of you.
Yeah.
The market's above that. Where do you think you're right, and where could you potentially upgrade how high you see rates going?
Well, look, on one day of the week, the market looks more dovish than us, and the next day of the week, they look more hawkish than us. That's just the reality of the market. So I don't draw too much from that, and nor do I spend a lot of my energy fretting about where the consensus is at. It's clear the momentum, and this has been true of this dollar bull run. I compare it to the road trip with your kids. You set off, and the kids immediately start saying, are we there yet? Are we there yet? Are we there yet? This has been the dollar bull run. Every moment in this dollar bull run, the market has said, right, is that dollar peak? Even yesterday. Do you think that's the dollar peak? Why? I mean, the Fed's still telling us we'll keep raising rates. Global growth is slowing. Risk aversion is pervasive. Mm-hmm. You're going to buy the dollar, at least for the next couple of months, I would have said.
Let's take a random tea leaf. I did Thai baht back to 1999 after the big blow up, after the crisis, and we're out 3 standard deviations, which is 0.8 standard deviations more than we've ever seen. How does the world adapt to Jerome Powell when they're looking at that depreciation or devaluation?
Well, look, we're in that environment again, aren't we, of our dollar, your problem. And for economies that are fighting inflation, a weak currency is a problem. But frankly, what can they do? I mean, look at the Japanese. They've tried, they stemmed the flow, but the reality is it's not a great deal to be done.
Is this a Fed that can listen to Bangkok and the 47 other Bangkoks that are out there?
I don't think we're at the point, and I think the Fed will take this view, that we're not at the point where the destructive element of a strong dollar is such a problem for the global financial system that we kind of have to navigate towards some kind of exit. We're just not there yet. And if you've still got core inflation at 6%, you've still got an unemployment rate that's historically low, the Fed will say, we've got work to do, and that's what they're telling us.
Right now, I'm just focused on the euro when that reaches a breaking point. I mean, we've seen it sort of hovering underneath the parity level. At what point does it become a problem that either triggers the Fed or triggers the ECB in some capacity, even if it's not their gig to play?
Yeah, I think it's already a problem. It's already a problem for the ECB. But the problem is, what do you do about it? There's not a great deal to be done. The ECB has belatedly matched the Fed for pace, but there's no way they're going to match them for level. So let's pretend we get to a point where both central banks have stopped. you're going to be sat on a dollar that's yielding considerably more than a euro. You're getting paid, literally paid for doing nothing, which is just fantastic. So, who's not going to do that? And if you've got the bigger issue for the euro, I think, is let's think about what you do with the dollar. To your point about rates and growth. When the Fed raises rates, you buy the dollar because rates are going up and because growth is going down, risk aversion. When the ECB raises rates, okay, you might buy the euro because rates are going up, but then you're selling the euro because European growth is going down. You got that ambiguity around the euro that the dollar doesn't struggle with. And that's why the dollar throughout this year has been buy the dips, grind higher, despite everyone saying, hey, is that the peak?
We've got about 30 seconds. I was speaking to Bob Michael yesterday. Lisa mentioned that earlier on. And he talked about the calm before the storm. Do you get the sense this ends with this cathartic moment of just this massive, massive demand for the US dollar? The kind of breakout we saw in March 2020. Are you anticipating that kind of thing again?
I view it slightly differently. I think we've been on a reasonable dollar trend, so like a boat trundling along the water towards the ferry port. But as you come into the ferry port, the stopping point, all the propellers come on, all the volatility, everything gets churned, and then we kind of settle. And maybe we settle into a port like a trading range for 2023. That's what I think we're heading towards, not necessarily some massive capitulation or final dollar surge. I think it's more about the vol that we'll get as we near the end of these cycles.